right, everyone. So I'm joined today with the two main guys at Middlefield, one of my favorite fund managers. So I'm with Dean Orico and Rob Lozon from Middlefield. Thanks so much for joining us, guys, today. I'm really appreciate it. I'm sure my audience will appreciate it. We'll go through a lot of questions today. So thanks for joining us today.
Thank you.
Thanks for having us.
All right. So I think just to get started, if you guys could maybe give me a quick summary and a history of Middlefield as a fund manager. I know you guys have been around for a long time. So just quickly summarize, if you don't mind, for my audience so we know a bit of the history.
Sure. Thanks, Adriano. Yeah, I'd be happy to. So Middlefield was founded in 1979. Rob and I joined in the, I joined the mid-90s. I think Rob a few years after that. So we've been with the firm for a long time. And we started in the real estate business throughout the 80s and then got involved in the energy business. So today we're talking about RS, real estate, ENS being Enbridge, being energy. So these are areas that we've been focused on, kind of experts in for the better part of the last 25 to 30 years. So they come natural to us. They're part of our core competency. And then as a general point, we really have carved out a niche as income investors, where we manage portfolios of income-oriented stocks. They're actively managed, so we believe in being selective and choosing sectors or stocks that we think make most sense depending on the macro environment and the underlying fundamentals. And today we've got a spectrum of funds across real estate, energy, healthcare, technology, all of which have a significant income or dividend component. So we believe investors should really have exposure to income in their portfolios. If you look back over 10, 20, 30, 50 years, Adriano, you would see that funds or stocks that have the ability to pay and grow dividends over time outperform virtually every other asset class. So we think as a result, investors need to have that type of exposure in their portfolios. So today we've got about 50 employees, head office here in Toronto. We have an office in London, UK, as well as in Calgary. And Rob and I are both based in the head office here in Toronto.
Perfect. Thanks a lot, Dean. Appreciate that description. And that's honestly music to my ears. As you guys know, my channel focuses pretty much on income-oriented investing, right? It's called passive income investing. So the fundamentals or the bread and butter are really the dividend-paying stocks with the income-enhancing strategies, which we will talk about today. So let's get in it right away. Let's talk about split funds. So I'm very excited to talk to you guys about split funds, an actual split fund manager. These are more niche and more lesser known funds and a little bit more complicated. So I'm really happy to have the discussion with you. So they're pretty complicated funds, pretty hard to explain to new investors, especially new investors. I know it took me a while to figure them out. So if you could describe the structure and the purpose of split funds in, 60 seconds or less, if that's possible, how would you explain it to an ordinary investor?
Yeah, let me take that, Adrian. Basically, think of it as a unique structure where we create a corporation that holds one stock, like our ENS fund, Enbridge, or a basket of stocks. And that's held up here, we call it the parent fund. Now, we see there's attributes of stocks. The two main attributes of stocks that we invest in is obviously we want capital appreciation. We want to own stocks that we think will grow, and we also like the dividends. So those two attributes are what are why we own stocks. And what we do is we create two classes underneath that top structure. And that's what the end investor sees. The end investor doesn't see this top structure that we manage day to day. They see the two funds below it. One is a Class A share that takes all of the capital appreciation or depreciation, but the volatility of the basket of stocks, that goes to the Class A share, as does any excess income. And we also create underneath a preferred share, which really is there for conservative investors that just gets a fixed quarterly dividend and a stream of income, but doesn't get any of the upside or the downside. So we basically separate the attributes of the stocks and make them more usable for two types of investors to meet their needs. One that wants growth and income and one that just wants income. And there's multiple ways investors can use those in tax sheltered accounts or non-tax sheltered accounts, but that's the simplistic kind of snapshot of what we do there.
Okay, yeah, and the Class A shares, like you said, because they take all of the the stock price movements of the whole portfolio, that's where the leverage comes in, right? So this is structure. Correct me if I'm wrong here. This is structural leverage. It's not traditional leverage like a loan facility. So that's why the Class A shares are, that's where the leverage comes from. Correct me if I'm wrong. Is that correct?
Correct. You could call it synthetic leverage, structured leverage. It's basically created within the product, and we don't go out and add more leverage to the product and take a bank loan or anything like that.
Okay. So why do you think these products are not as popular, and as far as I know, don't really exist on the US market? I was always curious about that.
Yeah, it's a good question, Adriano. And while there may be some securities laws, I think it's primarily more of a commercial issue. So when you think about the US market, there are a number of ways you can get income. They've got a much more developed bond market. They've got things like municipal bonds, which are extremely tax efficient. You've got a very robust high yield bond market, all of which you really don't have in Canada. So not surprisingly, equities in Canada yield more than equities in the US. So the average yield on the S&P 500 would be less than 2%. The average yield on the TSX benchmark is close to 3%. So in Canada, we're looking for ways we can get income. And over 20 years ago, there was the first split share structure, which again is a unique structured way that Canadian investors can get income, just the way Rob described it. We've got some underlying securities that pay out high levels of income, and we've created this structure because there is demand for that in Canada. And in the US, you just got other ways you can get income in your portfolio, so they've not really developed a split share market like we do have up here.
Yeah, and that makes perfect sense. I've always had trouble finding those high yield fixed income securities in Canada, but in the US, there's plenty of them. I own a lot of US listed funds that have those, that have high yield with fixed income, which is very hard to find. A lot of them are leveraged, so it makes perfect sense. So in Canada, like you said, it's typically more they stick with equities or finding the yield there. So the Class A shares, in my opinion, on the split funds is where the magic happens. So it could be hard to explain to someone how they could sustain such high yield. So in your opinion, how are they, in your own words, how are they able to sustain such high yields? My opinion is that because they capture everything, all the capital gains and losses, of course, and because a lot of these funds or the split funds typically write covered calls, is it fair to say that the Class A shares kind of capture double covered call income? What do you guys think?
Well, I guess it depends on the underlying portfolio. If you had a portfolio of high yielding underlying, like Dean's real estate fund, where you've got a lot of REITs that already give you 5 and 6% yields, and our ENS Enbridge fund, Enbridge itself pays a 6 dividend. So that helps, number one, cover the preferred fixed dividend, and then everything extra. So once you've covered that preferred share split call on the capital, the dividend, everything extra goes to the capital share. So if the portfolio manager chooses to be very aggressive on call option writing on a large portion of the portfolio, if volatility is 20%, you should be able to generate, if you're writing options on the portfolio, you can almost, you can match that and generate 20% yields on the portfolio if 100% of your portfolio is covered with call options. And then you'd have more than enough to cover a yield on the capital, in addition to the pref of 7 or 8 or 9 or 10%, whatever that is. But yes, it captures everything in excess of that first payment to the preferred. They have first claim on the assets. So whether it's capital gains or losses, whether it's extra dividend income from the underlying, so extra dividend income coming directly from Enbridge shares, for example, and in addition to covered call writing, all of that excess goes to the capital A share.
Perfect. Now that makes perfect sense. So ENS is a great example, right? You have the dividend of ENS, which is high sevens. The preferred shares is on ENS, and we'll talk about ENS, of course, in detail, is about 5%, I think, or 4%. So once, like you said, once the preferred is taken care of, everything else goes to the Class A shares, including the capital gains, the covered call writing, etc. So that's really how they have the high yields. That's perfect. Thanks for that explanation. Sticking with split funds in general, the two biggest concerns I get and questions I get is what I want to talk about next. So termination dates and overnight offerings. Those are the two major concerns I always get from audience members. So why do split funds have termination dates? Should investors be worried about that? What's the likelihood that the fund will actually terminate?
Yeah. So firstly, there's no reason to be worried about it. And the termination date is primarily driven by the preferred share. So as Rob described, you've got your Class A shares or your equity, and then you've got these separately listed preferred shares that have a defined term, duration, and yield. And what gives them some value is, in fact, that structure, Adriano. So when you buy a preferred share from a split share fund like ENS or RS, it matures typically in about 5 years. So people actually get their money back at that point. So that really is the termination. However, if the fund has done what we said it should do and performed, what happens, and this has happened time and again on split share structures, is that that preferred share, it terminates, it gets redeemed, so the holder gets their full money back, plus they've earned that dividend throughout the life of it. And then as long as there's appetite and the terms of a new preferred share are attractive, it would just issue a new set of preferred. So it basically continues. So the Class A share, nothing happens to it, but then the existing preferred share gets redeemed and a new preferred share is issued to clients on terms that are acceptable to the market at that time.
Right. That makes perfect sense. So in essence, it's not like you guys have the intention of terminating the fund. You always want to continue the fund, but you have to do a termination date because of the preferred shares, because it's something like a bond, like a fixed income security, right? Okay, perfect. That's what I usually tell people. And thankfully that's the case. So let's just say the fund does terminate. I know I get the question all the time. Let's say it does. What would happen to the Class A shareholder? The preferred, obviously, it's very protected. What about the Class A shareholder in case it terminates?
Sure. So you're right. And as Rob described, the preferred share has the first call on the assets. So let's take an example here that we have a preferred share with a value of $10, and we have a Class A share with a value of $15. So the unit together is 25. So at termination, the preferred share would be paid out at its redeemable value of $10. And then whatever's left over is payable to the Class A share. So if we decided for whatever reason we wanted to terminate this fund, and as we say, we've got no reason to do that, we would just issue another preferred share. But if we chose to terminate it totally, we would then just pay out that $15 value to the Class A holders. So they would just get that value in the market at that time.
Perfect. So once the preferred shareholders are taken care of, everything else goes to the Class A share. So in terms of, let's just say an example, ENS, which is past $16 in NAV, last I checked on your website, you would get the 16, whatever the NAV is left over, right?
You got it.
Okay, perfect. So hopefully that puts people at ease. And the second concern I always get is the overnight offering. So as we know, split share funds, they're closed-ended funds, right? So a lot of people have my opinion, wrong impression that overnight offerings actually dilute the value of the shares. It's a negative thing. So can you explain what overnight offerings are and what exactly they do to the fund?
Sure. It's a great question. And I think we need to start with, what do people mean by dilution? Dilution isn't just issuing more stock, Adriano. Dilution is really when you issue stock at a price that is less than what it's worth. So just to take that last example, on ENS, if the NAV of the Class A share is $16, we would be doing a dilutive offering if we were issuing Class A shares from ENS at less than 16. Right. And in fact, we cannot do that in these funds. We have to issue stock so that the net proceeds is greater than what they're worth. So almost by definition, they are always accretive. We are issuing stock, but someone's value is not diluted or decreased because we are issuing it at a higher price than what it's worth. And I think that's the best way to look at it. So when we do overnight offerings, which we've done several of them over time, they are always done on an accretive basis, i.e. the net proceeds raised are always worth more than what their value is.
Right. So this is why they're typically done when the fund is trading at a premium, not a discount, right? So would you say that this is actually a good thing, a positive thing, because you're giving out shares at a higher price than they're actually worth? Wouldn't that be, like you said, accretive, right?
it is by definition a good thing, because you're actually, when you issue stock at a value higher than what it's worth, you're actually increasing the value of that. The NAV goes up. Plus, right, Adriano, when you have your fixed costs of running the fund, the larger the base of the fund is, the more value there is. Those costs on a per share basis actually go down. And lastly, the more stock that's out there, the greater liquidity you have. So people who want to trade these things have more liquidity. So there are a number of benefits by doing these accretive offerings.
That's awesome. It certainly puts myself at ease, and I'm sure my audience members. So you heard it from the experts, guys. Overnight offerings are good things. This is why they typically do it when it's trading at a premium. So let's get into the specific two funds that I really want to touch on, RS and ENS. So RS is really the first ever one of a kind real estate focused split fund. So what made you guys come up with that idea?
Yeah, I'll take these because I manage RS and then Rob manages ENS. So perfect. We decided to launch RS about a year and a half ago, and it really emanated from, number one, as I described earlier, Jana, real estate is really at the core of what we do. We run several real estate funds, award-winning. We've got the top real estate mutual fund in Canada. It's our core competency. And then, in the fall of 2020, coming out of the pandemic, we really felt strongly that these REITs were truly undervalued. We thought the market was unjustly punishing them for the pandemic, and we felt that eventually, come into 2021, that you'd start to see an economic recovery and these REITs would recover. So as a result, we decided to launch a fund. We wanted to provide investors through RS an opportunity to really participate in that recovery, and that's exactly what happened. So when we launched the fund, we were buying stocks within this portfolio. We decided to, as Rob described, to do a basket of REITs, primarily in Canada. We had some US REITs as well, that we believed represented great value and had high income. And then over the course of 2021, that's exactly what played out, is that we were able to pay out high levels of income to investors, and the Class A shares actually appreciated in 2021 by about 55%. So that thesis that we had when we launched the fund turned out to be the case as the next 12 months unfolded. Yeah,
it did very, very well. And I agree with you. The market, there's always an overreaction when there's big events like COVID. A lot of any REITs that had retail, I think, got punished unjustifiably. RioCan, Smart Centers, and those were kind of at the top of your list in RS. So I have to give it up to you guys. Really, really awesome idea, and a really, really good success with RS. So I was in your initial fact sheet when you released it for RS, it stated, or I can't remember if it was there or somewhere else, but it stated that the fund wouldn't use covered calls yet because you wanted to fully capitalize on the appreciation, which completely makes sense, right? If you're writing covered calls, obviously you cap or you lower your capital appreciation potential. So is it still the case where you guys are not writing covered calls on any of the REITs in RS, or did you start writing them from a certain date?
Yeah, we like the covered call strategy, and Rob can talk about that in more detail. But within RS, we've not yet been employing any covered writing strategy. Okay. And the reason being, Adriano, we still think there's good value in this real estate in Canada. So even though last year was a very good year for REITs, they're still trading at a 5 to 10% discount to their underlying NAV based on our analysis. So, we still want to be able to participate in that upside. And put differently, when and if these REITs really appreciate and they become more fully valued, that's when we would more seriously consider writing some calls on some of these names.
Okay, perfect. Makes complete sense. And I trust you guys 100% to make that call. So the next question I have is more of a general covered call question regarding both your split funds. So what's Middlefield's view on the covered call strategy? Do you guys have a policy that's set in stone? And I'm talking about the moneyness of the options and portfolio coverage here, or is it, a dynamic approach where you revisit every month, every quarter, or something like that?
Yeah, I can take that one. It is dynamic. Okay. And typically we'll own shares of companies because we like the upside, or if we didn't, and we would probably switch them into something else. And that's more on Dean's portfolio, where he has the abilities to move around into different names. But like, we can use Enbridge as an example. When we launched the fund, Enbridge was kind of stuck in this $45 to $52 range, the actual shares, and and it was probably a tighter range, like 47 to 50, and it's finally broken out of that range. But when it was in that range, we wrote calls from time to time because it was kind of going sideways, but never right at the strike price. So, and it was probably 1 or 2 months out, and maybe 3%, 4% out of the money to give me some capital appreciation, plus a dividend or a call option premium of maybe 2% per month, or 2% every 2 months, which if you multiply that is giving you, 10 to 20% yield. But we didn't do the whole portfolio because we felt when we launched this fund, if you were part of the marketing campaign, when we talked to some of the advisors of why we liked Enbridge at between $45 and $50, because we always thought it was a $60 stock. So even when it was kind of stuck in that trading range, we only did partial covered calls because at any moment in time when the sentiment on energy, sentiment on pipelines turned, which is happening now, we didn't want to cap that upside. But generally it's dynamic. We're lucky that Enbridge and REITs have enough dividend income on themselves that we don't have to use covered call writing as a crutch. It's really an enhancer in the toolkit that we would use actively. So it's, to answer your question, dynamic's probably the right word to use. And we don't use it all the time.
Okay, no, that makes perfect sense. Obviously, you're not going to invest in something that you don't feel has any upside. So you're analyzing it month by month. I'm assuming if you feel like there's a lot more upside potential, you'll calm down on the covered calls. If you feel that it's going sideways, that's when maybe you'll start writing some calls. So dynamic, I feel, is actually the best way to go for these specific funds. So going back to RS a little bit now, how do you choose, Dean, which REITs go into RS? I mean, you're a real estate guy. Middlefield is a real estate and energy expert, like you said. What goes into the analysis to actually choose which ones to put in RS?
Sure. Yeah, great question. And let me first say, Adriano, that I believe the single best equity income vehicle in the market are REITs, bar none. It's predictable, it's growing levels of income, and it's extremely tax efficient. It's hard to find that combination of attributes in any other income-oriented vehicle. And as a result, we decided to launch this fund that's focused on REITs, real estate, in a split structure. Now, as you say, there are a lot of good REITs to choose from. And what we're really focused on is that combination of income, which is not only stable, but has the ability to grow. We want to own those REITs that can grow their dividend over time, and also ones that represent good value. So in essence, we're trying to cater to the two primary factors within a split share structure: income and growth, or capital appreciation. And if we can identify REITs, which we think are available out there, we run this basket of 15 to 16 names, and we think there are those number of REITs out there that offer that growing income with that capital appreciation potential. So going back to when we launched the fund in the fall of 2020, again, we were so adamant that this fund was appropriate for investors because we were buying REITs at that time, specifically in the retail sector, trading at 30 to 40% discounts to NAV. That value was almost unheard of. We were buying apartment REITs, which are trading at about a 20% discount to NAV. Plus, they had this level of income because they were collecting their rents, their occupancies remained relatively high, they did not cut their dividends by and large. So as a result, we thought we were getting that great 1-2 punch of growing income plus real potential for capital appreciation. So virtually everything we look at right now for the RS portfolio needs to meet those two primary criteria.
Yeah. And I have to give it up. Your stock selection, your REIT selection, I would say, is really, really good. Would you say that you're very focused on residential and industrial with RS, opposed to, say, office and other things like that?
So clearly, we like the industrial and residential sector. When we talk about industrial REITs driven by e-commerce, think about markets like Toronto, which have less than 1% vacancy in industrial real estate. Land is expensive here. And as a result, those REITs who have industrial properties in the GTA are seeing releasing spreads between 20 and 30%. That's how strong this market is. And keep in mind, this is a big industrial market. Toronto is the second largest industrial market in North America. You've got all these people, more online shopping. The other thing that's really supporting industrial REITs is really driven by the pandemic, and even now what's happening with the geopolitical crisis in Eastern Europe, where I think over time, North America, where all of our exposure is is going to be onshoring more of their manufacturing. They're moving from just-in-time inventory management to what we now call just-in-case inventory management. They're storing more of their goods here as opposed to just relying on goods being manufactured in places like China and shipping them over, because we saw during the pandemic how challenging that has become, supply chain issues. So we like industrial. On the apartment side, we think they also represent very good value. In Canada, we've got about 400,000 new immigrants coming in every year, and that's on a population base of 38 million. Those immigrants can't afford a home. They typically rent for the first 5 or 6 years before they can buy. So we think there's going to be even more demand for apartments. But as I say, even some of these retail REITs have done extremely well and still look like good value. We talked about smart centers, and our focus there, Adriano, is on those retail REITs who don't own shopping malls. We like the ones that own the grocery anchored, necessity based open air centers that, as I say, are anchored by a grocery store or anchored by, say, a Walmart, like a smart centers, because they're really servicing everyday needs, and they're not being hit the way, say, the shopping malls are and the department stores. So
right, more defensive.
like all of those sectors.
Yeah, more defensive. So yeah, I agree with you. I think where the growth is going to be is, it's always residential. Like you said, it's not rocket science to understand. Canada, a lot of immigrants coming in every year, all the time, which it helps that sector. And also industrial, like you said, you got to, for goods, you got to have the storage space, right? So that's where industrial comes in. This is why I always tell people I love RS. For me, it's my all-in-one go-to solution for real estates. So are you, Dean, constantly looking or monitoring the REITs to go into RS? Are you always looking for undervalued REITs, or are you really sticking with that bag of 15 and 16? Those are your core REITs.
Good question. And yeah, we're constantly monitoring the names that we own. We're always looking to identify new names, but we tend to run in RS and even on other funds, Adriano, relatively low turnover. So, for example, Cyrus One, which was a data center REIT that we owned in RS, just got taken over. So that's a reason why some names may be moved out. But generally speaking, you have relatively low turnover in the portfolio because we've done our homework on the names that we know and like. And, yes, some of them have some issues from time to time, but by and large, you're not going to see us trading around names. You're not going to see a lot of turnover in the portfolio. We tend to run what this is a really high conviction type of fund.
Yeah, I would say the quality is there too. I like to describe them as, I don't know if the expression you could say it, but they're pretty much blue chip REITs, right? They're the big cap guys. You don't have the really small ones under $1 billion market cap. So good quality there. So in terms of other REIT funds, let's compare RS to other funds. There's plenty of them out there. The most popular ones are really the passive index funds from Vanguard or iShares. So they each have one, right? There's VRE. They're all easy to remember because it's RE at the end. VRE is the Vanguard one, XRE, the iShares one, BMO has ZRE. So why would an investor choose RS over these passive index real estate ETFs?
Sure. So, when you're into more volatile markets, like we've seen in the last 2 years, like we've seen in the last 2 weeks, we really do believe if you've doing a good job as a portfolio manager, active management pays off, because not every sector within the real estate universe behaves the same way. Now, we've talked about industrial and multifamily and retail. Then you've got your healthcare REITs. So these are the nursing homes and the retirement homes. We know how hard they got hit during the pandemic. So we think if an active manager is really doing a good job, they can overweight or underweight each of those sectors to generate better risk-adjusted returns. And when you look at RS as well as some of our other real estate funds, we've done a reasonably good job doing that over time and generate some outsized returns. So for example, RS last year did about a 55% return on the Class A. Now the Class A comes with more risk because you've got the leverage within the preferred share. But if that's a risk appetite that you're comfortable with, you can generate some outsized returns.
Yeah, that makes perfect sense. In my opinion, active management, especially, you know, for you guys who are real estate experts, it makes sense, right? And it technically also, the, you know, a lot of people say, oh, the management fee, but the RS management fee is actually not that much higher from the index one. I think the index one is maybe 0.35 or 0.25. Correct me if I'm wrong. RS, it's only 0.85. So it's still under 1%. It's really not that much higher, but you get the expertise, the active management, right? So well worth it in my opinion. Yeah, that's perfect. Last question regarding RS, then we'll move on to a little bit on ENS. So the distribution started at $1.20 annually, $1.20 annually, but it was increased to $1.56 annually, just like ENS. So what makes you guys decide to do the increase? And on RS, do you see the 156 increasing or decreasing over the years? Is the goal to really hold it firm at $1.56? Because, you know, obviously for income investors, the most important thing is the consistency of the income. So how would you answer those questions or those concerns?
Sure. So, you know, when we increase a distribution or a dividend, we do that with the view that we're not going to cut it. So we know that investors are looking for that income and they want the stability in that income. It's always difficult to say, you know, when or if we increase it, but we always try to establish it so it's not going to be cut. Now, from time to time, you could see, you know, a major bolt out of a blue, huge recession, the sector gets hit. Then sometimes you have no choice but to revisit, you know, lowering the distribution. But, you know, assuming the economy performs the way we think it will, then, you know, you can expect the distribution to stay constant. Now, last year we increased it because, again, we talked about the performance in the underlying portfolio. We actually did start to see, by the time we bumped the dividend, already this recovery that we had anticipated when we launched the fund 6 or 8 months earlier. And that recovery was in the form of capital appreciation plus some dividends. So that gave us the comfort of increasing it at that time. So, you know, depending on how the portfolio performs, you know, in the future, that'll determine whether we look at whether we want to bump the dividend or not. But again, as I say, outside of some major issue, you know, economic major recession, you know, you can expect the dividend to remain at least at that level.
Perfect. Music to my ears, and I'm sure the audience are really happy about that. So thanks, Dean, for covering RS in detail. It was really awesome. I have a couple of questions for you, Rob, on ENS. So ENS, very unique split fund, right? It's I think one of the only split funds that I've seen that has only one company. And we're talking about Enbridge, of course. So obviously you guys are very bullish on Enbridge. It's a Canadian darling, dividend aristocrat darling. So why would you say you're very bullish on Enbridge?
Yeah, let me take a few minutes to answer that. One, it started with, it gives us the qualities that we needed for a split share, which is growth and income. So those characteristics where we thought the share price was going up, and it provides a great source of income to fund the structure. In fact, it's raised its dividend 27 consecutive years. So we're under the pretense that they're going to continue to raise that dividend going forward, which will help us continue to earn the dividend for both sides of the split share. Enbridge has a diversified and very strategically positioned asset base. Extensive networks of crude oil pipelines, liquid pipelines, natural gas pipelines, gas distribution, utilities, basically. My home in Toronto, I pay an Enbridge bill. They plug into my home and provide me with natural gas, renewable power generation. And, they move about 20% of the natural gas consumed in the US every day. And 2/3 of all oil that is US bound from Canada goes through Enbridge's pipeline. So wow. They're very strategically orientated, and we know how tough it's been to get new pipelines. The world continues to grow, population continues to grow. We need more and more energy. We're using almost 100 barrels a day of oil now, 100 million barrels a day of oil, and that was 90 million not too long ago. So we continue to use more energy, and it's tough to get new pipelines permitted, built. So pipes in the ground, in my view, it makes Enbridge look even stronger, because that's more of a valuable asset year after year, and especially ones that are operating. And now more than ever, given what's happened here in the last month, I think investors and the public, for that matter, realize the importance of energy security in your own backyard. So looking at what Enbridge has done over the last couple of years since we launched the fund, and one of our investment thesis was they're de-risking the business and making it simpler. And they've simplified the corporate structure. They brought down balance sheet leverage to a suitable amount. It was in that 5.5, 6 times debt to EBITDA. They brought it down below 5, and that's what the investors, institutional investors, wanted. And last year, they essentially finished all the capital expenditures on line 3. So a lot of the big CapEx is behind them. And, their business model is still in a steady state, 65% payout ratio. Their dividend now is just over 6% a year. That continues to grow. They can fund that dividend. Their business model is based on like 95% of their customers are investment grade. Most of their cash flow, 98% of their cash flow is based on contracts. 80% of their EBITDA has inflation protections. So that's key in this environment. And they're able to grow organically, and they've stated they can without needing to come to the market to raise equity. So in fact, this year at their annual investor meeting, they finally hinted at doing share buybacks. So giving investors return of capital, returning capital to shareholders. The tool they always used was growing dividends. Now, at the right time, they have extra cash to actually buy back shares, bring the share count down, which helps grow free cash flow per share. So we're still quite excited that this company can grow organically, grow cash flow at 5 to 7% a year. So there's the growth that through the A structure, the Class A, you're going to get some leverage on that growth and still fund a growing yield of 6+%. So they should return to shareholders low double-digit total returns, whether it's share buybacks, dividends, growth in earnings per share, growth in cash flow of 10 to 12% a year. So that's a business model that I'd like to have, whether it's leverage on for the next 5 to 10 years and continue to get a little enhanced exposure to that, or if I was just needing a bond-like instrument in my portfolio, looking at some of those points I just told you, that's a pretty good backstop that I'm going to get paid if I just owned a dull, boring preferred share, but I needed something to mature every 5 years for my laddered portfolio. And they're also very focused on ESG, and they screen quite highly on ESG. They've committed to being a global leader. They're focused on net zero emissions by 2050. They're investing in renewable natural gas, hydrogen, carbon capture. So there's sustainable reasons to invest in Enbridge as part of the energy transition. The company's not going away. They may look a lot different in 30 years, but they've got the backbone of their pipeline network to be able to transition, whether it's hydrogen we're moving around North America in 30 years. They've got the intellectual capital too, the engineers that understand carbon capture and hydrogen. So that's very valuable when employees are tight right now. So that's really our pitch on why we continue to like Enbridge as part of our diversified portfolios. We own it across a lot of funds, and we've got you a one-stop shop if you want to from time to time play just Enbridge as a single stock through this split share.
Yeah, well, thanks a lot, Rob, for that explanation, deep dive into Enbridge. I've always loved the company. Like you said, they have a lot of good stuff going for them. I always like to invest in the leaders, right? And Enbridge is definitely the leader in the pipelines. It's always in all major Canadian focused ETFs. And like you said, it's getting ready for the future as well. It has great balance sheet. So it's really a no-brainer if you ask me. I have just a side question. I've always wondered this. You kind of talked about it where, this is more of a pipeline utilities company. It's not really an oil and gas producer. No, it's not like a Suncor or a Canadian Natural. So why is it that, Enbridge and other big pipeline companies like TRP, Pembina, they're classified under the energy sector and not the utility sector, but those companies are always in a utilities focused ETF, for example? Is there, just curious why?
Well, some companies don't have the take or pay contracts like a Enbridge does. So Enbridge probably has the most utility-like structure of their competitors, where some of their competitors have marketing divisions that are quite, a good portion of their EBITDA that can fluctuate and don't necessarily have all the take or pay contracts. So you in theory can't use them as, a pseudo pure utility like a Fortis or a Mura that is basically a kind of they earn a return on a regulated asset base. So that's really the reason, and maybe at some point that changes. But yeah, right now they're still kind of viewed as a energy infrastructure portion of the energy index, right? Okay, perfect. Thanks for that. And we've already, the next question was about the covered call strategy in terms of coverage and moneyness, but I think we've already discussed it, that it's really a dynamic strategy where you're really, the bread and butter is really not the covered calls. That's just an enhancer. The bread and butter is really the capital appreciation. So that's okay. $1 million question now. I get it all the time. I've made a few videos regarding this. Why would an investor choose ENS instead of Enbridge stock? Right. So let's talk about the two share classes of ENS, right? Because really, if you look at Enbridge, the stock in the middle here, on the far left, we'll call it the preferred share. So if you just want safety and cannot stand losses in your portfolio, we've created a class of a share, the preferred share, that has very good downside protection, and that you have a very high probability of getting your money back and not seeing a lot of fluctuation in day-to-day NAVs. It's typically $10, $10.10, $10.20,
Right.
And in fact, for this term of the preferred in June of 23, so less than a year and a half, is the termination date. So if you were just looking to park some money for a year and then reconsider what you wanted to do with it, that's a pretty good place to park money right now, because the fuse on the fund, which the termination date is coming up. So you can that's great for a bond like fixed income investor. Now moving to the right side, sure, with Enbridge, you're going to get a mixture of their 6% yield plus growth. But if you think Enbridge can meet their business plan, perhaps beat expectations, maybe do some M&A acquisitions. If oil stays generally high here and energy stays in vogue, the multiple on that stock may grow. Enbridge used to have a 14, 15 times EV to EBITDA multiple. So if it gets back to that, which it was like 10 years ago, this could be a $65, $70 stock. So if that's the case, and you see a lot more upside in Enbridge, and you can take on the risk because the Class A shares would be considered higher risk in your portfolio, then you would choose the Class A because you're getting a higher yield, close to 10% right now, plus you get leverage to the upside if Enbridge does go up. And it cuts both ways. If we go into a recession, if all stocks go down, the Class A will perform more poorly than owning the Enbridge shares.
Right. Perfectly explained. Like you said, on one side, you have the preferred shares, which is really meant for safety. In the middle, you have the Enbridge stock, and then you have ENS on, if you're really bullish, if, you get the higher risk, but the highest reward. And, I would always go with ENS because I'm a long-term investor, right? A long-term buy and hold investor that fluctuations, short to medium term fluctuations don't mean anything to me. As long as I keep getting paid every month, and I'm okay. So this is why I tell everyone, go with ENS instead of Enbridge, because you're just getting more yield and because of that leverage. So thanks for that explanation. It was really awesome. Last question on ENS. I know I'm keeping you guys for a long time. I don't want to keep you for a whole hour here. Since Enbridge, you mentioned it before, keeps increasing their annual dividend every year. I'm not sure if they're going to keep doing that. I'm assuming they will. Do you think the dividend will eventually go up on the Class A shares for ENS as well? Or do you plan really just to make it firm at $1.56 and let the capital appreciation go?
Well, in fact, the dividend on the capital share is not guaranteed or static. You'll see a press release from us monthly that kind of approves the dividend, because we have to take a look at the portfolio and make sure the preferred dividend is covered.
Right.
Then the board of directors can say, release that dividend. That being said, we have raised it in 2019. We model out what we think Enbridge can do over the next 3, 4, 5 years. And we would only raise it again if we thought it was prudent. Right now, Enbridge's yield is, approximately 6%, and our fund is giving you 10. I think that's enough of an enhancer. And so, never say never, but short term, it's not something that we think is needed. But we do regularly, annually look at it, model it out, and hopefully Enbridge keeps bumping their dividend. Obviously, I could pay out a higher dividend if I thought Enbridge was going to stay at $55 for the next 3 years. I could do a lot more covered call writing and earn some more premium. But right now, it's kind of baby steps. I wouldn't expect an aggressive increase by us, year after year, because it's already such a high yield. We want to do what's prudent to investors to help grow their NAV of the Class A and give them high levels of income.
Perfect. Prudence is the word I really focused on there. And this is always the word you want to hear from your fund manager. So very reassuring for me, and I'm sure for the audience as well. So thanks a lot, Rob, for covering ENS in great detail. Last 2 questions I have is more really for the future. So income strategies, in my opinion, obviously I'm pro income strategy. They're getting more and more popular. You see more firms like Hamilton ETFs, Harvest, Purpose coming out with new covered call solutions, and even some new all-in-one covered call solutions where they group many covered call ETFs together. So is Middlefield thinking about creating more income-oriented ETFs or split funds in the future that are really focused on the covered call strategy?
Yeah, go ahead, Rob.
Yeah, definitely. We think covered calls, especially, a year like this, when we look forward, it can be a little bit tougher to make capital appreciation. We've got higher rates, we've got inflation. Obviously, we've got some headwinds to global growth right now, given supply chain issues and the unfortunate war overseas. So this is an environment that covered calls could work. And we've modeled some ideas that we can't really talk about here, but that would work even for stocks that don't pay as much of a dividend. You would just increase the amount of covered calls you would get. If we think that basket of stocks, sort of like what REITs looked like 2 years ago, perhaps that basket looks very enticing right now, and we could create that growth and income side of it. So yeah, definitely thinking about it for new split ideas. But in fact, at our internal portfolio management meeting this morning, we even discussed it just again across all of our funds that we manage day to day that we didn't talk about today. This is an ideal scenario where volatility is high. The VIX almost hit 40 this morning. So you're getting high premiums, and the market's generally going to go, I'll call it sideways this year. We hope we'll get some growth later in the year and definitely into next year. But this is a really good opportunity. This is a good environment. This is the perfect environment for covered call rating.
Glad to hear you say that, because my bread and butter of my portfolio and my channel is really the covered call strategy. And like you said, it shines in this type of market. So this is where a lot of people tend, with the higher volatility, retail investors tend to panic. They're a little bit more on edge. This is where I feel the most comfortable, and I'm super happy to be a buy and hold passive income investor, reliant on those covered calls to shine. So hopefully you guys come out with, I'll definitely be watching, and hopefully we'll have some future funds from you guys regarding those covered calls or based on covered calls. So last question. So Middlefield, Dean, like you said at the beginning, right, it's really income oriented. And I noticed, I've always kept an eye on your funds. You guys have a lot of, or had a lot of closed-end funds that are, they typically have the word dividend in the name of the fund, which I really, really love. No covered calls on them, but you're looking at, yields of 5% usually on these nice basket of stocks, either more innovative technology, agriculture. You guys came out recently in the last year and a half, 2 years with a bunch of cool new funds. And you recently announced the revamp of your closed-end funds. A lot of them you're transitioning to ETFs. So tell me what made you come up with that decision, and what does the future look like for these funds? Are you gravitating more towards ETFs?
Certainly, we're looking to build out our ETF platform. So as we talk more and more to our clients, really trying to understand how they're investing their capital, we're getting more feedback that they're looking to ETFs. So it really does circle back, Adriano, to this point that we, like you, have this shared view that income makes sense for investors. So whatever fund we launch, we want to ensure that it has an income dimension. So whether that would be, as you say, in technology, whether that be in healthcare, whether that be in agriculture, whether that be in just a broad equity portfolio, we believe we can offer that strategy to investors with a significant income component. And what we've just announced and is just approved by investors is to take some of our legacy closed-end funds and convert them into ETFs to cater to some of those investors who like to play ETFs versus, say, closed-end funds or mutual funds. So we've just converted, or will be converting shortly, our Global Innovation closed-end fund. We have an infrastructure closed-end fund, which is converting to an ETF as well. And then we have one of our more diversified equity funds, our Global Dividend Growers Fund, that is broadly diversified across equities, but focused on equities that are growing their dividends. So we've taken all those three and converting them, merging some other funds into them so they become larger and more liquid. And then that really does broaden out our platform of ETFs. And we're going to have mutual funds basically mimic those funds or even invest directly in them. So if an investor prefers a mutual fund over an ETF, they can buy the mutual fund version of that same strategy, where they can get income within a specific area of the market, like the ones I described. So we'll continue to launch split shares. We'll continue to launch closed-end funds, as well as building out our family of mutual funds and ETFs, all of which have this constant narrative that runs through them of income, giving income to investors.
Perfect. Glad to hear that. And I saw you had a nice little graphic to tell you, and I'm going to put that link in the video description below for my audience members, where you could see all their closed-end funds and the transition, which ones they're merging into ETFs. And I was quite excited to see that you have a, besides RS, you actually have a real estate closed-end fund and a real estate ETF called IDR, which was my go-to for real estate prior to RS. And now you guys are merging those two and putting them into a real estate ETF, right? So in case, some audience members are not comfortable with RS because it's leverage, you want something a bit less aggressive, a bit more safe, you guys do have a actively managed, unleveraged, correct me if I'm wrong here, new real estate ETF coming up, right?
Yeah, you got it. So we've got our real estate mutual fund that you mentioned, which has been around for many, many years, and it just won the award from Morningstar Lipper as the #1 real estate mutual fund in Canada over the last 5 years. And then, as you say, we have our real estate ETF, trades under the symbol IDR, which just won the Fund Data A+ award, so one of the top real estate ETFs in Canada. So you're right, we have this expertise, and we can offer it to you in a split share structure, in an ETF, or a mutual fund, depending on how you like to invest your capital.
Yeah, and congrats on those awards. It just justifies that you guys are real estate experts, right? And this is why I always tell people, when it comes to real estate, I trust my friends at Middlefield. They know what they're doing. They've been in the business a long time, and those awards just justify it. So congrats to you guys for that, and having a really great firm. You've been around for a long time. I wish you all the success in the world, and thanks so much for joining me. I really, really appreciate it. And if you have any final words, go ahead. I'm good on my side. I kept you guys long enough, I think.
I just want to say thank you, Adriano. We appreciate your support. We appreciate your kind words. And, really, we're just in the business of trying to provide investment solutions for individual investors, like the ones who follow you and your YouTube channel, trying to get them investment strategies that help them make sure they're earning superior risk-adjusted returns. And we think income, as I say, and have said a number of times, is a great way to do that.
Yeah, perfect. So again, thank you so much, guys, and we'll hear from you soon.
Good. Thank you. Have a great day.
Thanks for watching, everyone. I really appreciate it. Please show your appreciation by hitting the like button, hit that thumbs up button. It's free for you. It takes 2 seconds and it helps the channel grow. So it's a win-win. Also, if you like this type of content, this channel is all about investing for passive income. There's stock picks. I got a lot of great content coming up. I'm always thinking of new content. So make sure you're subscribed and hit that little bell button next to the subscribe button so you're notified every time a new video comes out. You don't want to miss my new content. We also have a website. Make sure to check it out, passiveincomeinvesting.ca. That's where you could purchase my digital product, the ultimate DIY investing package, which is on version 3 right now. I'm very proud of this product. It's a companion tool, a reference tool to really help you build your own portfolio, whether you're a Canadian investor or an American investor. There's sample portfolios in there according to different investing styles, not just income, what I do, but there's also some growth and dividend themed sample portfolios in there. And it comes with lifetime updates, so you only need to purchase it once. So make sure to check out my website for all the details on this product. There's also a video there where I show from A to Z what this product is, so make sure to check it out. Also on my website, I offer right there on the homepage a one-on-one consultation service with yours truly, me personally. It's a 1-hour Zoom meeting face-to-face in case you want more personalized help, where I go over your situation, help you build a portfolio according to your own needs, answer all your questions, help you transition a portfolio. Whatever your needs are, I will do my best to help you. I love doing these sessions. I limit myself to 4 a week. They sell out very quickly, so I apologize for that. I know many of you keep sending me emails. I always miss the consultation. Well, I can't do more than 4 a week because I need the time also to create more content. So just look at the little message on the homepage there, right on top of the calendar, to get a status if the calendar is open or not. But I will let you guys know via YouTube community post and a Facebook post when the new appointments are open. Speaking of Facebook, make sure you join our Facebook group, which is almost at 10. We're almost at 10,000 members now and going up every day. So it's a nice little group where people post their questions, they put their portfolio, and we all try to help each other out when it comes to passive income investing. So make sure you join us there. We're also on Instagram. If ever you want to know a little bit more about our personal day-to-day life, you could follow us on Instagram if you use that social media platform. Don't forget, guys, the mission of this channel, my mission, will always be the same. It's to help everyday, normal, regular working people to invest on their own in order to build their own stream of passive income to enhance your quality of life and one day become financially independent. So how do I always leave you? Make sure to continue staying safe, stay healthy, and of course, stay passive. See you next time.